Hi, I'm Ian Smith. I'm the managing partner of Transition Advisory Partners, and this is my weekly post called Transition Thursdays. It's really meant for business owners and their advisors as they contemplate transition of the ownership of a business. And that could be to family, it could be to management, it could be to an outsider. So each week I try to have a different topic that is relevant to that community. And this week I was going to actually talk about something completely different, but the Canadian government released their federal budget, and it has some pretty important or big implications for entrepreneurs of sizable businesses or business owners that have capital gains in their business from the sale of equipment that has gains on it, or the sale of shares, of course, in the business. And so I thought it's really important to talk about that in the context of a transition of your business, as opposed to the more traditional tax or accounting approach, which you'll hear from your external accountants or your tax advisors. So what happened with this budget? Well, first of all, it's actually not a surprise to me that the Canadian government has increased this inclusion rate on capital gains, because it's one of the most politically acceptable, if you want to call it that, acceptable alternatives for them to raise taxes without increasing the marginal tax rate on all Canadians. So they've made a big pitch to say that it really only affects a very small number of Canadians. But those Canadians it does affect are the people, my clients and people like myself that have businesses that are creating jobs and helping drive the economy. So it's hitting those people more than it's hitting them when it's not hitting any kind of salaried employee or somebody making just wages for a living. And so because of that, the impact is not as widely held. And so it's probably considered less politically risky for them to do that to help pay for the deficits that they're running. So I don't want to get into the politics of it, but that's why I think they chose this alternative for raising taxes over other things that they might have been able to do. So what have they done? Well, they've increased the inclusion rate from 50% to 2/3, or to 66 and 2/3. And so what is an inclusion rate? An inclusion rate is the amount of the capital gains that's actually going to be taxable. So if we use big numbers, big round numbers, if you had $1 million capital gains, up until this comes into effect in late June, you would be taxed on 50% of that gain. So $500,000 of the gain would then be taxable. And if you're at the high tax rate, let's call it 50% again, you would pay $250,000 or 25% taxes on that $1 million gain. So that's a lot of tax to begin with, $250,000 on every $1 million of tax for gains that you've made in building a business or building assets that you sell. So what they've done is they've changed that inclusion rate from 50% to 66 and 2/3, or 2/3 of the capital gains. So that inclusion has now gone up to, in my example, to $666,667. And if you use the same tax rate of 50%, your tax bill will be $333 and $333,333, which is $83,000 more than it would have been prior to these changes. So it's not 16% more, going from 50 to 66 or 67%. It's whatever your marginal tax rate is multiplied by the change in the inclusion rate. So if you have a larger business, it can be a very, very significant tax increase for sure. So what can you do? Well, unless you've got an offer and you're going through due diligence, it's highly unlikely you're going to be able to sell your shares now. Although there may be ways to crystallize the gains today, and tax experts, I only know enough to be dangerous, but tax experts can probably find a way to maybe crystallize some of those gains today and pay a lower tax rate and have less capital gains in the future. That may be one alternative. But it is definitely too late to try and sell a business in order to take advantage of the lower tax rate. So what I would suggest is really start to really take seriously some of the advice I've given and others have given over, probably given to you if you're a business owner, to really get your tax structure, your tax situation under control. Understand in Canada that as a business owner, if you have a qualified business in Canada, and there's lots of explanations and serious math that goes into figuring out if your business qualifies for what's called the lifetime capital gains exemption. And that's a great benefit for business owners. So for every business owner or every shareholder of a qualified business in Canada, you have a lifetime capital gains that's indexed to inflation. And this year it'll be around about $1 million of tax-free capital gains. So if you're married and you have kids, you can spread that capital gains around as long as those children and your spouse are qualified shareholders of that business. You can qualify for that that tax-free capital gain. So that's something that I think every business owner should be fully aware of, should make sure that their business will always qualify for being a qualified business under the rules for the lifetime capital gains exemption. And just don't wait. Like the next thing that I think the federal government could do in a future budget is to reduce that lifetime capital gains exemption, or stop it being indexed to inflation, or pull it back, or change the qualification criteria for what it means to be a qualified business under those rules. So don't wait. Talk to your tax advisor. We'll wait till tax filings and everything is over, maybe at the end of the month. Give them a bit of a breathing break, but really get your tax situation in order so that whenever that time comes to transition your business, it's structured properly to minimize the capital gains on all the value that you've helped to build in the company for your employees, for your family, and for the community. So that's my thought for today. As I said at the outset, leave a comment below, and also I'll leave the link, or put the link down here at the bottom for our newsletters. We send out newsletters every 2 weeks, and if you don't want, we can unsubscribe you if you sign up. But there's some really good content there every 2 weeks as well. And we also have some white papers which are a little more detailed explanation about certain transition related topics. So if you sign up, you can have access to all of that on our website, and I will see you next Thursday. So thank you very much.